My name is Bernice Garcia. You guys can call me B. That's what my friends and family call me. B as in like boy or like a bumblebee. So I work for a company called Unitas Community Credit Union. But today I am here to teach a workshop put on by Financial Beginnings. We were invited by Feed the Mass to come talk to you about money. How many of you, raise your hand if you like money? Right? What do you usually buy with your money? Do you have like a store you go to? Are you like a Dutch Bros fan? I know some people like going to get the Rebels. Shoes? Video games? No? Well, today we're going to talk about how we spend our money, right? Everybody should have a pen. If you have one that doesn't work, again, I left the box at the front so you can just come up and grab a different one if that one doesn't work. We're going to start out today by drawing a $1 bill. Now, if you open up your packets, everyone should have two. One of them says spending one, and the other one says credit one. First, we're going to be looking at spending one. So that's the one you want to open up. Okay. So spending one. I want you to turn to page 2. So page 2 should look something like this, right? And page 2 is the side that has the big yellow, light yellow box at the top. Okay. So I'm going to give you all 2 minutes. 2 minutes to draw the front of a $1 bill from memory. If you have a $1 bill on you, don't cheat. This is just to see how much you can remember. Okay? So I'm going to start this. Let me see if I can get it to go. Oh, I went too far. Okay. 2 minutes to draw the front of your dollar. Starting now. Make it as detailed as you can. We're going to talk about what's on the dollar bill in a second. If you finish the front side, feel free to draw another rectangle to draw the back. Okay, we're down to the last 30 seconds. Okay, time is up. Okay, so does somebody want to share with us their picture? Anyone want to share their picture? Okay, can someone tell me who's on the $1 bill? Abraham Lincoln. He's on one of the bills. George Washington's on the $1 bill. Abraham Lincoln is on the $5 bill, though. So he is on one of those. There's a short list because we only have up to $100 bills, right? So there's only a handful of presidents that made it on there. Do you guys know which dollar bill doesn't have a president on it? I think, let me double check, but I think it's the $10 bill. Yeah. So Alexander Hamilton, he was not a U.S. president. The $20 bill, I think, has Andrew Jackson on it, President Jackson, yeah. So Alexander Hamilton, not a president, but he did start the U.S. Treasury, and that's why they put him on the bill. So the $1 bill, though, right, our friend here just told us that George Washington is on the front of it. Was there anything else that you guys got on it? What else goes on the $1 bill? Yes. Yeah, on the four corners there's the 1 to tell you that it's a $1 bill. And it has the 1 on the front and the back side. Yes, yeah. So that no matter how you fold it or where you grab, what side you grab it from, there, 1 is on there and you're going to know which bill you're touching, right? What's different about the back side from the front side? The front has more details, yeah. The back. So the back has more details as in like design and picture-wise, right? The front's a little more plain. But the front has some key information that makes this dollar bill a dollar bill. So at the top, it says Federal Reserve Note. It has the country that issued it, so the United States of America. And then it says, there's a tiny note underneath that says, this note is legal tender for all debts, public and private. This quote right here is what makes this legal. Have any of you ever gotten fake money or bought fake money at like the dollar store? Or sometimes I used to have this little cashier, like a toy cashier machine, and it came with fake money and a fake plastic credit card. But those toys, right, they usually say something that, even if they're a different size or made out of different paper, they'll say something that says something funny or that it's not legal tender. And that's what makes it, that's why you're not able to use something that looks like a dollar bill unless it has that statement on it. Now, there's a couple seals on the front of the dollar bill. One of them is for the, Federal Reserve Bank. And the letter tells you where it was printed. So this one's from San Francisco, the specific one I'm holding. And then on the other side, you have the seal of the Treasury. There's a couple signatures. It's usually whoever the secretary for the Reserve and the Treasury are. And then again, you have a year when it was printed. And then on the back side, does anybody know what these symbols are? No? So this is the first time I asked this, and nobody says Illuminati about the pyramid. But the pyramid's actually called the Pyramid of Province because of the eye on top of it. And then underneath it, there's some Roman numerals and stuff that just have the date that the Declaration of Independence was signed. And then on the other side, we have the Great Seal of the U.S., right? Now, when we look at this, this is pretty much like old school money, right? It's very like green, kind of gray, kind of green. But we have the $10 bill, and this one's more colorful, right? Do you guys know what other bills are colorful? Yeah. Yeah, different parts of the world have bills that are different colors. Mm-hmm. Yeah. Yeah. And you know why they put colors on their bills? Yes, it helps know which is which, and it also helps deter people from trying to make fake money. So if there's different colors that maybe have different shades, and some countries even use like a different type of plastic coating on their bills or different materials. Have any of you ever thrown a dollar bill in the wash machine on accident, like to wash your clothes? What happens to that dollar bill? Yes, it was perfectly fine, right? It might be a little crinkled or, wet, but it's perfectly fine. So although we call this paper money, it's actually not made out of paper. right? Because paper would disintegrate and fall apart in the washing machine. It's actually made out of a cotton linen blend. And while you could burn it, it's not going to fall apart if it gets wet. So now that we talked about money and we just drew our pictures of a dollar bill, let's talk about what gives this value. Do any of you like or know, raise your hand if you know what Pokemon is. Do any of you have Pokemon cards? Yeah? Why do you collect Pokemon cards if you have any?
I just collect them. I collect a lot.
Cool.
I have this huge.
Awesome. I only like to collect the ones that I feel like the pictures look really cute. Like maybe they're knitted or their Pokemon's made out of clay or something, right? But we tend to collect things because we see value in them, right? So what gives the dollar bill value? Is it because the president said so? Do we give it value? Right? We need to be able to buy things, and money gives us the ability to do that. So we're the ones that give it value. We all collectively have decided that this is what we're going to use to buy and obtain things. Pay for housing, buy new shoes, buy food, go on a road trip, pay for gas, buy cars, all that sort of thing, right? We all agreed that this is what we're going to use, and this is why the dollar exists. It holds value that we give it. So, money, we just talked about how if it goes in the wash, it doesn't disintegrate. You can still use it once it dries off, right? Currency needs to be 4 things. It needs to be durable, meaning it's not going to fall apart easily. It's going to last a few years. It needs to be transportable, meaning I can just throw it in my pocket and take it with me easily. Maybe put it in my purse. It needs to be dividable, meaning if something doesn't cost $10, I can use a $1 bill or I can get change, right? It needs to be dividable, and it needs to be hard to counterfeit. That's why some of the newer bills now come in different colors. You might have seen people maybe erase the bill to see if the president's head shows up. That's a security feature. So these 4 things is what makes money be able to be money. It needs to last, right? Do you guys know that way, way, way back before we had money, we used to use farm animals as currency, right? So, but could you imagine having to take a cow with you to exchange it for something else? It's not really transportable. I can't just throw the cow in my pocket. And it's not really dividable unless it's morbid, right? To think of that. You can't really divide a cow to be able to pay for something that's maybe worth less than the cow is. So that's why we had to come up with currency, to be able to exchange things for an exact value. So we're laying the foundation down today, right? We're going to talk about how we spend money. We're going to talk about financial services, financial institutions, and also when we do set up an account and we're managing the way we're spending our money, how do we try to reduce the fees that come up in life? Last week, you guys had a presentation from somebody else, right? What did you guys learn last week? Or what did you guys talk about last week? Budgeting, yeah? Okay. So budgeting is going to come into play with this as well. Budgeting kind of has its way of weaving through your life in different parts of finance. So with that said, let's talk about financial services. So money, right? Everybody likes it. Helps us live the life we want. Money makes the world go round. What do you guys think this quote means, or the saying? Money makes the world go round. We wouldn't really be able to do a lot of things if we didn't have money, right? So the phrase just basically means that to an extent, money does make the world go round, in the sense that we need it to buy food, to pay, to have a roof over our heads. And sometimes we need it also to go from point A to point B, right? If I take the max, I need to get a ticket to get on the max. So still, it's important though that we don't keep, well, having money is really important. It's important that we don't keep all of our money stashed up in our house. Can somebody tell, like, why would it be dangerous to keep your money at home? Yeah. Your home could burn down, yeah. Your home could burn down, and money, again, it's not made out of paper, but it does burn, so you could lose your money if you have it at home. Yes?
You know how you can like get insurance on health and cars?
Yeah.
Could you get insurance at a bank?
Yes.
If you keep some of your money in your house and it burns down, will they replace it?
Yeah, we're going to talk about that today. So you bring up a great point. What was your name? Ace? Okay, nice to meet you. So Ace brings up a great point. So when you put your money in the bank, it is insured up to a certain amount automatically, because the federal government says the bank has to insure your money. So it is safer sometimes to have your money in the bank than have it at home, because the government says, hey, if the bank loses your money, we'll give you that money back, right? You're covered. So how does banking play into money management? So we need to keep our money safe, and that's why banks and credit unions exist, so that you can keep your money safe. Do any of you have a bank account already? Savings or checking? Yeah, you have an account? How did you get your account? Your parents set it up for you. Did you have it since you were a baby, or was it like more recently? Oh, cool. Yeah. And then do any of you have a debit card or credit card that you use? Yeah. Is it like your parents and they let you use it, or? It's yours? Very cool. So debit cards are attached to your checking account, right? And credit cards are a little different. We're going to talk about that in the second lesson today. So the two options that are most popular when it comes to putting your money in the bank tends to be a savings account and a checking account, right? That's usually what most people have. So when we talk about banks, we're going to be talking about it in two different ways today. So banks. The word bank can be a noun. And if you remember, a noun is a thing. So like a table, a school, a park, a stove. Those are all nouns. But it could also be a verb, which is an action word, right? To run, to swim, to walk, to sit. These are all verbs. So a bank is a noun as a place, but you could also say, I need to bank, meaning you need to have a place where you can put your money, right? Or you need to do financial transactions. So that's how you would use it as a verb and as a noun. So why use a bank account? So we talked about one reason, right? Your money is a little bit safer because it's insured. So if the bank loses your money, the government will give you that money back. What's another reason people would use a bank? Would it be, like, let's say that I have $5,000 in my bank account. Would I want to be carrying that around with me if I didn't have a bank account? Would you want to carry around $5,000? $10,000?
I mean, I'd love to have it, but I don't want to carry it.
It's a lot of responsibility, right? I've lost $20 before, and I was pretty upset about it, so I can't imagine if I lost $1,000 or more. So, right? So banks provide us a safe place to put things. They also kind of take the responsibility off of you, because you don't have to carry around money. And today, let's say that today you might not have $1,000 in your account, but maybe in 10, 15 years you might. Or maybe you have $500 in your account and you want to keep whatever money you have safe, right? So Also, another thing to remember is that having a bank account can also save you money. Have any of you or your parents ever had to buy like a money order or a cashier's check, or have to go to a check cashing place to cash their paycheck? So a lot of these places, right, they're usually like stores or places you can go into yourself that do these types of services, will charge you a fee to get a cashier's check, a money order, or to cash your check. And you might be thinking, well, why would they charge me for this? And it's because they're providing a service. So there's usually a fee associated with these things. When you have a bank account, a lot of times your bank or credit union will provide these services to you for free because you are an account holder or a member of the credit union or bank. So they want to keep you there as a customer, so they will take care of those fees for you. You don't have to pay to have your check deposited or cashed. You don't have to pay to get a money order or a cashier's check. Now that depends. Sometimes they do have fees for those types of products, but they're usually lower than they would be at a store or a check cashing place. So again, having a bank account can also save you a lot of money. Sometimes you won't even need to get a check or a cashier's check because you might be able to just pay online with a debit card or account number. All right? So, how does the banking system work? So, when you were young, you might have been introduced to a bank at some point. Maybe you have a bank account since you were little. Maybe you just recently got a bank account set up. Or maybe you've driven by a bank before and you know where you can find a bank in your area or where you live, right? So when you put money in a bank, what do you think the bank does with that money? They put it into a vault. Do you think the money stays there until you need it? So that's actually, at the end of that day, they probably will put the money in the vault. But the money doesn't stay at the bank until you need it. The money actually gets lended to people that go and ask for loans from the bank. Usually, if you have a savings account, the bank pays you back with interest. Sometimes it's not a lot, just depends on your bank or credit union. The bank pays you back with interest, and then the bank makes money by charging interest on the loan. So they're charging somebody else for borrowing money, and they're using your money to lend out to people. Again, the bank keeps your money safe, so it's not like you no longer have money in your account. Your money is still there. It's just that they've used the funds you've put in there to loan out to somebody else. What could you get when you go to a bank besides accounts? What else could you get at a bank? Loans, yeah. Credit cards, like you mentioned, credit cards. Loans. If you want to buy a house, would you go to a bank? No? Why not? You might need some money, so you might need to go to the bank to get a loan to buy a house, because houses are really expensive. So if you have a business, would you want to go to a bank to set up your business? You might need to. If you have employees, you might need a business account to be able to pay them out of. And sometimes banks and credit unions can offer services to businesses, like if you have a food cart and you need to have a machine to pay from, like a Square machine or something, they can help set that up so that it works easily with your business account, right? The money goes directly to your bank account, that sort of thing. And they might even be able to provide you discounts if you have a business and you need some merchant services, which is like the machines to take credit cards and debit cards. So, next, let's talk about checking and savings accounts. Again, I mentioned those are the two basic ones that like everybody has when you become an adult. Most people have when you become an adult. So what's the difference? So you said you have a credit card? A debit card? So how does it work? Where does it take the money from?
My mom's bank.
From your mom's bank, okay? So your debit card is attached to your mom's bank account, okay? And then, so when you have a debit card, the money comes out of your checking account, right? Checking accounts are really important because they're usually the account you use for your daily spending. So that's going to be where you get your money to go buy lunch or to go to the corner store and get some snacks. So your debit card is your checking account. Your checking account is the one you want to use for your daily spending. And then sometimes, just depending on what type of checking account, it can earn interest, meaning the bank is going to give you back money for putting money in that account. Those are not very common, but some banks and credit unions do offer that. So savings. Savings usually manages money you're putting aside for later. So this could be emergency funds, or maybe you have some goals like, oh, I want to go on vacation, so I'm putting money aside. Or I want to buy a new pair of shoes, so I'm going to put money aside so I can buy those new pair of shoes. Savings also has limited withdrawals. This is the main reason why you don't want to use your money from a savings account to use it as your everyday spending account. Usually, you're only allowed to withdraw from a savings account 6 times per month. This is because the government wants to make sure that you are actually putting money aside to save, right? So when you put money in a savings account, you could take it all out, but from like your mobile app or over the phone, you could only transfer up to 6 times per month. And that's technically, it's a federal law just to make sure that you have money set aside. And then savings accounts always accrue interest. Now, remember I said sometimes it's not very much. Sometimes it can be a lot. It just depends on where you're banking, right? So, what about student accounts? So when you're a minor, meaning you're under 18, you'll probably need a parent or guardian on an account with you. When you turn, I believe it's 11 at most places, you could get a checking account and a debit card with parent or guardian permission. But some places offer something called a student account, which you could have from as early as 11 up until you are done with college. So these student accounts sometimes offer a lot of benefits, like it might be completely free. You might be able to get checks for free. You might have less limits on certain transactions. So that's really important. Also, they might be able to allow you to withdraw from ATMs that are not from your bank for free. It just depends. But sometimes you want to ask your bank or credit union what types of accounts they have for students, right? So, some more differences between a debit card and a credit card here. Debit card, as our friend mentioned, is attached to a checking account. For a debit card, you must be 13 years or older, and that depends a little bit on bank or credit union. It's your money, so when you swipe your debit card, it's coming right out of your account, and that's your money. You don't have to pay the bank any interest because, again, it's your money. You can use it when you want to. It doesn't build any credit history. So that's important because when you use it, it's just like using money, except you're swiping a card instead of having different dollar bills. And then you must usually, if fraud ever happens on your debit card, so let's say that somebody does a transaction that you didn't do on your debit card, it usually takes longer to get that money back than if you were using a credit card. Now that's important to know because a lot of times people say, I don't want to put my credit card information to buy something online. But it's actually safer to use your credit card than it is to use your debit card because your debit card is connected to your money and a credit card is connected to money that belongs to the bank that they're lending you. So when fraud occurs, it seems a little selfish, but the bank would rather get its money back first. So they're probably going to settle the fraud sooner because it's their money than when there's fraud on the debit card. Usually they have to do an investigation on a debit card to find out whether or not it was fraudulent or it really was used. So it might take a couple days longer. So that's important to know. Also, debit cards, they require a PIN number. Usually it's 4 numbers most of the time. And that allows you to buy things. You'll need the PIN to buy things at the store. And you'll also need it to withdraw money at an ATM. Credit cards. So credit cards, it says here you need to be 21 years old. That depends. So 21 years old on your own. Usually if you're a college student, you might have to wait till you're 21. But you can get one at 18 on your own if you have income. So 18 years old, if you have stable income, you could get a credit card on your own. If you do not, you will need a cosigner at 18. So credit card, you're borrowing to pay in the future. You usually have to pay interest on anything you don't pay by the end of the month. So if it carries over to the next month, you're going to get charged an interest fee. And it's a percentage depending on how much you spent. And then it does build credit history. So that's important because credit, as we're going to learn in the next lesson, helps us live the life we want to live. And then it is also, as I mentioned, it's easier to dispute charges on a credit card. And sometimes credit cards can earn rewards. Do any of the adults in your life have a store credit card? Like Kohl's or a Macy's or a Best Buy or a Fred Meyer's card? Store credit cards sometimes can help you earn rewards. And that's what gets people to open up these store credit cards, is that you think, oh, I'm going to be earning some points. And sometimes they're really beneficial if you really, really do only shop there, or if you really like the store brand. It can be very beneficial to have a card from them to get those rewards. Sometimes, though, you need to be careful because those store credit cards can have higher interest rates. That means they're going to charge you higher fees each month for the money you're spending. So it's just important to understand the differences between a debit card and a credit card. Okay, so having a bank account, again, opens the door to do so much more. So we talked about all the stuff you could do at a bank, but besides accounts, you can also have a safety deposit box. Does anyone know what that means? So safety deposit boxes are very old school now, but if you've ever been to a bank and you walk in and they have a really fancy vault with all these little silver boxes, has anyone ever seen that? When you walk into a bank and there's a vault, it looks really fancy. So in that vault, if you've ever seen it, it doesn't actually have money in it. I mean, it could, but it doesn't. Most of the time, people rent out these fancy silver boxes, and there's different sizes, and those boxes, you can put whatever you want in it. You usually pay once a year for it. People will put personal documents in there, their wills, medical records. People will put titles to their car or their homes. Some people put jewelry in there, or their important documents like Social Security cards and passports. It's just the way, it's almost like having a safe, but it's at the bank. So you have to go to the bank to get to it. Some people like that because then they don't have to keep all that stuff at home, right? They don't have to worry about somebody breaking in or stealing their safe, that sort of thing. Again, we talked about car loans, mortgages. So a mortgage is a loan to buy a house. Credit cards. Banks also have online banking. Most banks and credit unions offer online banking now. So that's usually looks like an app that'll let you see all of your transactions, your balance, and they might have additional tools in there. You can also get certificates of deposit. These are often called CDs. Has anyone ever heard of putting money in a savings account and then not touching it for a while? They'll be like, oh, you can't touch this money for 6 months. Well, that's technically what a CD is. You pick how long you want your money to sit in an account, and you can't touch that money for that period of time. And if you do, you have to pay a fee because you agreed to keep that money in there for, it could be 6 months all the way up to 5 years. And the benefit to you is that your money is going to be safe, and it's going to be earning interest, and it's usually higher than it would in a regular savings account because you're promising to keep that money there for a certain amount of time. And then retirement savings. You can open up accounts to save for retirement. That's super beneficial. Sometimes some people need to do that so they don't have to pay a lot of money in taxes. And sometimes it's just so that they have money when they retire. Another question for you. Have any of you ever gotten a check like for a birthday? Or seen your parents' like paycheck? Yeah? What does it look like? Like fancy? Is it like handwritten or is it printed?
It's like a piece of paper with a bunch of documents on it, like why you got the check, and signature,
Mm-hmm.
and then there's the amount.
Mm-hmm. So like a paycheck might come with additional documents, right, that have a lot of information about your work. Yeah. So, yeah, that's pretty much. A paycheck just looks fancier. It's a piece of paper. There's important information on the check that tells the bank, like, hey, you need to send us money over into this person's account because this is their paycheck. Or this is the paycheck their grandma gave them, the check their grandma gave them for their birthday or something. So we're going to watch this short video here. It's a little skit from SNL. If you don't know what SNL is, it's a show that comes out on Saturdays. Not every Saturday, but the short skit here. And they're talking about checks. So pay attention to what they're saying. Let me see if it plays. I might have to move it over. Is it up there? Mm-hmm. Okay. Does it have, let me see. Okay. It's striking. Okay, sorry. Let's see if I can find my mouse. There we go.
A little to the right?
This way? Yep. Okay. Awesome. So, what'd you guys think about that? Okay, nobody here has written a check, right? And some of you haven't even seen a check. Do you think checks are still very popular? No? Yeah? No?
That's how my sisters get paid for their job.
They
They get checks.
get checks, okay. So, like, employers will use checks. But a lot of times, people don't use checks very often anymore. Most people now, like she mentioned, might use something more digital, like Venmo or Cash App, or they might have direct deposit. So some people have never seen a check in their life. But today, we're all going to see what a check is going to look like. So, on page 5 of your activity book, page 5 should look like this. It's the one with the light yellow boxes and the check right in the middle. On page 5, I want us to discuss some reasons why you might use a check. So, Ace told us that you might use a check if you get paid. So all of her sisters get paid with a paper check. So I want you to write on their paycheck. What's another reason somebody would need a check? Could you use a check to pay your bills? Mm-hmm. Yeah, so paying bills would be another one. For about everything, yeah. I've seen people write checks at the grocery store. Buy groceries. Maybe you need to pay to have somebody repair something. You could use a check for that as well. Okay, so looking at page 5, right? There's a check right in the middle. We're going to fill it in. And the cast from SNL here told us what goes on the check, right? At the top is the date. Pay to the order is just a fancy way of saying this is the person who's getting paid. Pay to the order of. So here you're going to put who you're going to pay. And then here you're going to write the amount in numbers. And right below the pay to the order line, you're going to write the amount in letters. The memo. The memo stands for memorandum. It's honestly, not a lot of people use that word, right? But really, the memo is just you putting on there what the check is for. It could be for babysitting. It could be for rent, for working 40 hours. It could be whatever for that memo. It could be for being the best friend, the best sibling. And then the line that is not labeled at the bottom is where your signature is going to go. So I want you all to write a check to somebody. It could be to anyone. But I'm going to tell you the amount. So the amount it's going to be for is for $525 and $525. Okay, no worries. First, does anyone want to share who they wrote their check out? Okay, perfect. I was about to ask if anyone made it out to themselves. You deserve it. Okay, so did anybody put anything on the memo line? Hey, so you wrote it out to yourself. Did you put anything on the memo line?
I put, because I deserve it.
Because you deserve it. That's right. So memo line, again, can be anything. And sometimes people don't even fill it in, and that's okay. It doesn't have to have it. It's optional. So we just talked about all the reasons why you would need a check. Now, what are some alternatives to using a check? Cash. Okay, yes, you can use cash. If I'm at the grocery store, what's an alternative to me writing a check? Could I use a credit card at the grocery store? Yeah, I could probably use a debit card. What about my cell phone? Could I use my cell phone to pay? Yeah. What on my cell phone would allow me to pay? Cash App, yeah. Apple Pay, yes. And then, of course, Google and Samsung Pay as well, because they have those as well. I know. Well, if you have an Android phone, yes. But Apple Pay would work. I could pay with my phone. What if I'm with somebody else? Something that they mentioned in the skit. I'm with somebody else and we're splitting the check. How could we do that? We're splitting the bill. We could use Venmo, Apple. I think it's Apple Cash is what it is. You could send money through there. Cash App, is there another one I'm missing? Sell. So these are all applications that you can use to send people money. It could be as easy as like, hey, I forgot my wallet. Could you pick up my tab? And then you'd send them money. right? Because it's attached to your bank account. So, checks yourself. We just did that. So don't worry about that. Now let's talk about financial institutions some more. So we started this section at first when we're talking about like choosing your bank, right? And we're going to talk about that some more now. So it's important for you to know how to identify what's the best financial institution for you. So where do you want to bank? Yeah.
Are we moving on to a new topic?
We can.
Or
It's still
transitioning from checks?
transitioning from checks. Yeah. Okay.
Just want to keep having them moving around.
Yeah, we can take a break once this one's over. I think I only have a couple more slides. Oh, no. Well, we'll get through it. Okay. Okay, so you need to know how to identify the right financial institution, right? So I mentioned I work at a credit union. Do any of you know the difference between a bank and a credit union?
Credit unions only do credit cards?
No. So although we have credit in the name, credit unions and banks offer the exact same things. You can get a mortgage, a car loan, a bank account, a savings, checking, retirement account. Everything that a bank offers, you can get at a credit union. The difference is that credit unions are owned a little differently than banks. So banks are for-profit institutions, meaning they're business, right? They want to make money. Which is a lot of times why it's a little more expensive to have an account at a bank, just because they might charge you monthly maintenance fees. And they might have higher like overdraft fees if you don't have enough money in your account. So they use those fees to make a profit so that the owners or the shareholders of the banks can make money, right? Credit unions are not for profit, meaning we do charge fees as well. But those fees don't go to owners of the company. They go back to the members of the credit union in the form of lower fees, lower interest rates for loans, and higher interest rates for deposits. When you open an account at a credit union, you become a member of the credit union as opposed to a customer. So you actually become part owner of the credit union. So it's a little different, more community-oriented, and they're usually smaller. So we talked about some apps as well that you can use to bank and pay people. Have any of you ever heard of something called a neobank? Honestly, I hadn't heard about it till I learned through this too. But neobanks are banks that are fully digital. They don't have any branches. You'd open an account online. And then you would just use your money. You could set up direct deposit to it. Sometimes Cash App and Venmo can work like a neobank where you can have an account with them and deposit money in there. Something to be cautious about is that the neobanks, a lot of them don't offer the same type of insurance that banks and credit unions do. So your money might not be insured. So it's important to make sure you know that before you start using it as an account. So choosing a financial institution. 4 things to consider. How accessible do you need your bank or credit union to be? Do you want a branch in your community? Or are you like, I don't really want to have to go into a branch, so I want to do everything digitally? Fees and income, right? Do you want to set up direct deposit? Sometimes that gives you lower fees. Products and services. What kind of products do you want? Do you want checking and savings, or are you looking for something else? Do you want a safety deposit box? And then what other things are important to you, right? What about like ATMs? Do you want to be able to access ATMs that are from other banks and credit unions, or just the one that you bank at? That's important to know as well. So at the end of the day, though, your decision on where you bank, it's yours, right? It's just based on what's important to you. So what will you need to open an account? So a couple things you need to set up an account when you decide you want to open a bank account. You'll need an ID. Has to be government issued, could be from the state, or could be something like a passport. Another form of ID could be a credit card. If you have never had an account before, you might be able to use other types of IDs. Proof of address. the bank needs to know where you live so that they can send you information about your account in the mail, your social security or ITIN. If you're undocumented, you can also have a bank account. You just need to have a ITIN, which stands for Individual Tax Identification Number. That's what it stands for, sorry. I don't remember that one. But anyone can have a bank account as long as they have a tax ID number. So, next, how to properly maintain your accounts. When you are looking for an account, it's important to know that you need to stay on top of things. Because you can get in trouble and then it gets hard for you to open an account later down the road. So you need to be able to check your balances regularly. That's why online banking can sometimes be really helpful. You can use automation, so you can set up automatic transfers or automatic payments, direct deposit, for example. You can consider consolidating. Sometimes if you have too many accounts at too many places, it can get really hard to make sure you have money in all the accounts at the right times of the month. So sometimes consolidating everything into a couple accounts might be easier to manage than having too many. You need to decide where you want to keep your money. Again, do you want to keep more of it in your savings so that it's set aside for later? Or do you want to keep more of it in your checking so that you have it there to spend whenever you want? You need to make sure that you're not overdrawing. And overdrawing is when you buy something or something gets charged on your account and the money isn't there in the account to cover it. So that's considered an overdraw. You want to make sure you avoid fees, maybe by using ATMs that are in your bank or credit union's network, so you're not getting charged for that. And then setting up direct deposits can sometimes waive like a monthly fee or something like that. So, account matchmaking. Okay, if you turn to page 8 in your workbook, page 8 should have 2 yellow boxes here. Okay, so at the bottom here, you have 3 accounts, account A, account B, and account C, right? I want you to look at, so your account is account C. That's what we're going to call it. Account C is your account. And I want you to look at account A and account B and compare it, right? So when we're looking at the institutions, so your account's account C, and when we look at the monthly fee, account A has a $10 fee, but they'll waive it if you keep $500 or more in there. You need to keep at least $1,500, so $1,500 every day in there. That has to be your daily balance, right? And you need to have $5,000 set aside in a savings account. Otherwise, you have to pay $10 every month to have that account. But it says there's no minimum balance. So it could go below those limits or those minimums, but then again, you're going to have to pay the $10. Account A, they don't offer any interest on their checking accounts, and their savings barely makes a tiny bit of money. ATM fee, they don't charge anything on their ATMs, but if you use somebody else's, like if you, let's say you bank at Wells Fargo and you need to use Bank of America's ATM, they're going to charge you $5. Locations, they're practically everywhere. They're a popular bank. And they have all the bells and whistles of online banking. Account B, it costs $50 to open, and then, you need to have $50 to open the account, and $0 after that. There's no monthly fee. They have no ATM fee at their ATMs or for any of their partners, but they do charge $3 at any ATM that's not in their network. Locations, there's no locations really close to you, so it's not very convenient. Mobile banking, they have the basic, but they don't offer photo deposit, so you can't take a picture of your check and deposit it. And then your account, account C. Account C has no monthly fee. They have no minimum balance. Their interest is a little bit higher at 0.25%, so that's 1/4%. And they don't have any ATM fees. Uh, the locations, though, there's no locations. They're online only. But their online banking, because they're online only, has all the bells and whistles. So, which one of these do you think would be best for you? Does anyone want to share which one you feel like, oh, I'd probably want to have that account? Does anyone feel like they're all not good? None of these are that great? I personally think some of these are great, and then I wish I could combine, pick and choose, right? But that's why we have to look at these types of things and find out what financial institution is best for us. Oh, wrong button. There we go. So fee reduction. So we got to understand how to minimize those fees and how to improve our cash management. So again, we talked about looking at service and maintenance fees, because those get charged monthly normally. Understanding what the minimum balance is of our accounts. How much do we have to keep in the account? How much is the overdraft fee? Is it $25? Is it $45? ATM fees. Also need to know, if I ever have to use an ATM that doesn't belong to my bank or credit union, how much is that going to cost me? $2? $5? And then foreign transaction fees. This really only applies if you travel, if you go to another country and you use your debit card to buy something. The bank might charge you a foreign transaction fee. So it's usually a fee to exchange the currency. But it's all digital because it's your debit card. And then return deposit. If you deposit something and it bounces, like let's say your sister gives you a check and it doesn't go through because they didn't have enough money, how much are they going to charge you for processing that? So that's all important to know so that you can avoid these types of fees. So again, great tool for you as you're learning to manage your money is to monitor your account, and using mobile banking is really helpful. Okay, so how can you send someone money quickly and for free? So we talked about Venmo, Cash App, PayPal, and Zelle, right? These are all applications. They're for the most part safe to use. You just have to be responsible when you're choosing to use that on who you're sending money to, because it can be hard to get that money back. So all these applications can be very helpful and make it easy for you to send money to friends or family. Okay, so when to consider changing. Sometimes we have a bank account and we're not loving it. So if you're not liking where you're banking, there's no reason, you don't have to stay there. So I had a bank account with a different bank when I was a minor, and then when I turned 18, I decided I was going to go bank somewhere else. So I did. And I enjoy now being able to have lower fees. Sometimes if you're looking for specific accounts or services, you can also look at what other banks or credit unions offer. And if it's not convenient for you, for example, if you bank at a community bank or a credit union, there might not be locations for you where you're moving, if you're moving. So it might not be convenient for you to keep that account open. And then sometimes if your income has changed, and now you're making a lot more money, it might be more helpful to go somewhere that has more resources for you to manage the higher income you have now. So now that we've discussed all of the stuff about spending and banking and how to keep your money safe, I'm going to give you all a break so that you can use the restroom, get up and stretch, and then we will come back for our second session, which will be, should only be an hour. So, yeah. Tabitha, anything else?
I was wondering if you were able to talk a bit about if you go to a credit union, you're part owner.
Yeah. So,
What does that mean?
yeah. So, because credit unions are community owned, when you go to a credit union, they might charge you a fee to become a member to join. This fee usually is for you to become part owner. So you might set up with a savings account that has a minimum balance that stays there that you can't touch. And those, it could be as little as $5. It could be as much as $50. But that is your share of the credit union. And as long as you have an account there, that money stays in that account. When you choose to close out your account, you will get that money back. That's basically how it works, though. Again, there's benefits to banking at a credit union because they're smaller, you're more likely to be known, you might be getting lower fees, the accounts might have more products that are free. So that's basically what that means, really, that you might pay a fee to join the credit union, but then you have some benefits with that as well.
Cool.
Yeah. Okay, so would you say how long should they be?
We'll have a 5-minute break.
Okay, great.
I'm gonna walk around.
All right,
Get
thanks.
water.
credit, right? And you talked about credit cards. But credit applies to more than just credit cards. Again, there are going to be some big words that pretty much only get used when we talk about credit, so just bear with me through those. Some of them are even hard for me to pronounce, because I always say this, but English is not my first language, so sometimes some stuff is hard to pronounce. So, what's in a name? So I believe we're going to look at page 2 of your workbook. So this is the workbook that says Credit 1 at the front of it. Credit 1. And page 2 looks like this. It's blue at the top and then has like a light yellow box at the bottom. We're going to do the what's in a name activity. So there's a scenario here. I'm going to read it out for you. So a friend asked to borrow some money from you. List some of the questions you would ask them before deciding if you would lend them money or not. So your friend asked to borrow money. What are you going to ask them? So go ahead and fill that in. Try to come up with 2 to 3 questions of what you would ask them. And then I want us to share and talk about those. Okay, I'll give you all a few more seconds to finish up. We're going to share, so if you didn't have time to come up with 2, you can write one down that someone else says. Okay, so who wants to share one of the questions they wrote down? What's something you would ask someone who asks you for money? When are they going to pay you back? That's a great one. If you're going to give them money, what if you need it before they're able to pay you back? You probably want to know when you're going to get that money back. What else would you ask your friend if they ask you for money? Would anyone want to know what the money is for? Would it change whether or not you gave them money if depending on what they were buying? Yeah, right? If they're buying something they don't really need, then it's like, why would I? I don't know. You have to really trust that friend, I guess. Anyone have any other questions that they would ask a friend?
How do they plan on getting the money back?
Yeah, that's important too. Are they going to give it to you all at once? Or are they going to have to pay you in payments? Right? Would any of you ask, what's in it for me? Probably, right? It might depend on how close you and the friend are, whether or not you feel like you need to know what's in it for you. So, when you think of the word debt, that's D-E-B-T, what comes to mind? Is debt good or bad?
It depends.
It depends. You got 2 bads and 1 it depends. Yeah? So, when you think of the word credit, what comes to mind? Is that good or bad? Credit, good. Debt tends to be associated with bad, right? So, here's the thing. Debt isn't always bad, right? Sometimes debt helps us achieve some things. Do you know anyone or have you heard of anyone who has student loans? Right? Yeah? I have some of those. So student loans, it's a type of debt, but it's able to help you. Getting in that debt helps you pay for college, which most of the time helps you make a little more money. So let's lay down the foundation for the next hour we have together. So we're going to be talking about debt, borrowing, and credit reports. Things that are very important. A lot of this won't apply until you are 18, because that's the earliest you can start building credit. If you have a credit card under your name, it might be because a parent set it up for you with using their credit score, and they just were able to get you a card under your name. So let's start with debt. So let's understand the proper uses of debt and how credit affects debt, because they're in a relationship, right? We ship them. So some of the proper uses of debt include, like I mentioned, having maybe student loans, right? You kind of need that to get something else. You might need debt to be able to get like a car or a home. Those are big purchases that a lot of times we just don't have the money laying around to buy it like right out. So we just talked about this. Is debt a bad thing? Are there good reasons to accumulate debt? Again, maybe student loans, maybe buying a house. It's not necessarily a bad thing, so it just depends, like Ace mentioned. It's important, though, to realize that you can leverage debt to be able to live the life you want to live, right? Again, student loans are very important in this because they might allow you to have a job that might be a little easier or not as labor intensive, or maybe you might be able to make more money that way. So what is credit and how does it relate to debt? We talked in the last lesson, we talked about how you'd have credit cards, right? And credit cards isn't your money, it's money you're borrowing from the bank that you'll pay back later. But other than credit cards, does anyone know what credit is? Aside from credit cards? Yeah, credit score, it relates to your credit, yeah. So credit is the ability to borrow money to obtain things by paying either a little bit or nothing at all and then paying it back later. It's the same way as a credit card works. But credit is the actual ability of being able to do that. So the advantage for the person lending or the bank institution lending the money, that's what's in it for them, is that they make money off of lending you money because they're going to be charging you interest and maybe some other fees. Interest payments can add up, so it's important to know how to manage your debt and your credit so that you don't end up paying much more than what you originally intended to pay for something. So where does credit comes into play? What do we need credit for? So we talked about buying a house. If you want to buy a car, you might need credit, right? Depending on what kind of car you want. I bought a car. It was only worth like $10,000, but I still needed some money to buy it, so I financed part of it. If you want to get a credit card, you're going to need, that's credit. If you want to get student loans, that's credit. But there's some other reasons why you might need credit, right? So if you are applying for a job, not a lot of employers do this, but some of them can. They can look up your credit report, and that way it will essentially what they do that for is to try to figure out whether or not you're a trustworthy employee, right? So some employers might look up your credit report. You might need credit to set up auto insurance. I don't know if you knew this, but car insurance depends on your driving record, but they also take into account your credit as well. So sometimes you might get a higher payment if your credit score is not as good. And they do that because, again, they see it as a way to measure your trustworthiness. And then if you want to rent an apartment or house, your landlord or the management company, they will probably pull a credit report for you, again, to find out how trustworthy you are. Now, the system of credit reporting it's not the best, but it's what we have. So that's why a lot of companies use it. Another last one that's not on here is cell phone service. Sometimes they might look up your credit score as well. So debt, how to take advantage of it. So again, advantage is that you get something now. You have spread out payments. Some loans might have tax advantages. But if I don't have the money and the PlayStation 5 just came out and I really want it, but I don't have the money to pay for it, I can buy it right now before they sell out, and I could have it tomorrow, right? I could go pick it up at Best Buy or something. And then I have it now and I'd make payments later. Versus I could wait and save my money, but I don't know if they're going to sell out of PlayStation 5s again, and I'd rather have it now and I'll just make payments later, right? So that's an advantage, is if you need something now, you could get it with a credit card and pay it off later. But it's important that when you do choose to buy something, especially if it's a bigger purchase, that you're thinking ahead of like, oh, I want to make sure I pay it off in 3 months, and that you don't have that balance carrying on for a whole year, because then you're going to pay like a lot more than what that PS5 is worth. So some disadvantages, though, to debt, again, is paying interest. So if I drag it out, that PlayStation 5, and I pay it for a whole year, I'm going to pay way more because of the interest. So it may be tied to collateral. So if you buy a car or a house with a loan, so a mortgage or a car loan, that car or that house is collateral, meaning if I don't make the payments on my car or my house, the bank can take it away from me. If you have a lot of debt, it also does decrease your net worth. So that's like how much you have overall, including things you own, like cars, house, everything. So, but if you take out a loan and the bank can take it away, it's not fully yours, so it does decrease your net worth. So debt, once it starts accumulating, it can get out of control, because it can be hard for you to find tools to decrease the debt, right? It could be hard for you to get a loan to pay everything off and then only have one monthly payment because you already have a lot of debt. But thankfully, there are some helpful tools out there. You could do, like you can go into a debt management program, and there's all sorts of stuff that you can get help with if you feel like you're stuck with debt at some point. So weighing the debt options. So turn to page 3, which you should already be opened up to, because it's the one right across from page 2. Page 3. So weighing the debt options. So you're a recent high school graduate with plans to take a gap year in order to save more money to go towards your college education. Review each scenario and fill in your decision from the list below. So example, so I'm going to read this out, and then I want you to choose. You can just tell me, or you can write it in, but I want you to choose which one of these decisions you're going to make. Are you going to forego your savings, meaning you're going to take your money out of your savings account to buy or pay for this decision? You're going to pull from your savings, so you might take some of the money out, but you're not going to take all of it out to pay for one of the statements. Are you going to borrow money, so ask for a loan or put it on your credit card? Or are you just going to hold off? You know, I can wait longer. Okay? So, first statement. The new PlayStation is coming out, and you want to be one of the first ones to get it. What are you going to do? What would you do? Yeah. You really want it? It's the new one?
I would prepay, so like then I would get it like before everyone else does.
Okay, so you would prepay. And then are you going to borrow money, or are you going to take it out of your savings?
I would borrow money.
You'd borrow money, so maybe put it on a credit card? Okay. Would somebody else not be interested in buying a PlayStation 5, a new PlayStation? Yeah? Does someone here think, I don't really want a PlayStation? You don't really want one? You kinda? You don't really want one? Okay, yeah. I'm a fan of the Switch. Is it the Switch? Why am I forgetting everything's names? The Nintendo Switch. I have one, but I probably wouldn't buy a PlayStation. So I might just hold off on it, you know? But it depends. Our values drive how we spend our money, right? So it just depends. So you're presented with a once in a lifetime opportunity to backpack in Europe. What are you going to do? Raise your hand if you would forego your savings. So just give up on your savings and just go do it. Use all your savings. Raise your hands if you would take some money out from savings. Okay? Raise your hand if you would borrow money to do it. And then raise your hand if you would just hold off. Okay? You just hold off. Okay. So, next one. You back into a pole and your bumper is caved in, causing $400 in damage. The car is still drivable, but you'd like to fix the bumper. So you can still drive your car, but the bumper has a dent. Are you going to forego your savings to fix it? Are you going to pull money from your savings account? Maybe not all of it, yeah? Are you going to borrow money to fix it? Or are you just going to hold off because you can still drive it? Just hold off? Yeah? Yeah. Yeah. One time somebody hit my car, and I got the important parts fixed, but I didn't fix the dents in it because I was like, it still drives. It gets me where I need to go. So true story, it really happened to me. So after working and saving all year, you still need $3,000 to pay your college tuition, but you want to enroll now. So you need $3,000 to start college, but you don't want to wait another year. You want to do it now. What are you going to do? Are you going to forego your savings? Pull from your savings? Borrow money? I'd borrow money or hold off. Yeah, I borrowed money because while I had some money in my savings account, at the time that I was in college, it probably wasn't $3,000. And also, I wanted my savings for other emergencies that might come up. Okay, so pretty much when you're weighing your debt options, you pretty much have to figure out what are your needs now, what are going to be your future needs. Do I want to use my savings so I have credit available to do something else? Do I want to use my credit so my savings is there for a rainy day? You have to plan ahead and kind of try to figure out what your needs are now and what they're going to be later on. So when we're talking about debt, it's also connected to borrowing. So understand how to calculate the cost of borrowing and what affects it, right? So let's learn how to calculate some of the cost of borrowing money, because it's not free. So a couple questions you need to ask yourself is, does this debt help me or hinder me from my plans and my goals, right? If I buy this PlayStation on my credit card, is it going to help me or is it going to hinder me more from achieving some of my financial goals? And maybe it doesn't matter to me because I really want one. Just depends. Next. You need to ask yourself is, does the debt repayment fit into my spending plan? And one thing to keep in mind, just because you can't afford it doesn't mean you should take it out. If I can afford a $300 payment on something, like if I want to buy a second car or something, and I can afford a $300 payment, but I'm going to be a little tighter on spending money, you might want to think twice because it might get really hard for you to manage. It gets hard to stick to a budget when you're not giving yourself enough money to spend on things you want, right? So taking on debt is going to create a liability for you and a payment that you're going to have to fit into your monthly budget. So you need to take into account, do you have enough income? And not only do you have enough income, but is there going to be enough money for you to still put a little bit of money in your savings and to allow yourself enough money to spend on things you want to do and you want to buy? So, what is the total cost of this debt? So, it's not very fun to think about how much more you're going to have to pay if you borrow money to buy something. But it's important to be able to calculate that so you're aware of the big picture. So when you're trying to do that, you need to understand how much amount you're going to borrow. So if the PS5 is $500 and my credit card is going to charge me 15%, and also there might be an annual fee or something, then I have to figure out how much that's going to cost me and how long I'm going to be paying off that PS5 for. Sometimes you'll see credit cards that will say that you can get 0% interest for 12 months or something like that. And if you choose to go with one of those, it's a pretty good deal actually, but you need to be aware, is there going to be annual fees? And also, am I going to be able to pay off whatever I'm buying in those 12 months? Okay, so what are some factors that affect the total cost and payment? So 4 things you need to keep in mind when you're trying to figure out how much it's going to cost you to really buy something on borrowed money. So how much are you borrowing? The length of the term, which we discussed, depending on how long you're going to be paying off that $500 PlayStation, that is going to affect how much you're going to pay. The fees, are there annual fees? Do you get charged more if it carries on to the next month? And then the interest rate, how much are you going to be paying in interest every month? Sometimes some debt has additional fees, not even just the annual fee, but it just depends on the credit card and what type of product you're using. And then the interest rate. If you choose to use a credit card, the interest rate might also change month to month. So it's important to understand that too, because you might get charged 17%, but then it changes based on the market, and then you might be paying 18% next month.
I have a question about that.
Yeah.
Is there like different things that those types of rates are called? But how would you know if you're going to get a credit card that could change it up on you anytime?
Yeah, so all credit cards have something called variable rate. And so they do change, and you should be able to look up what interest rate you're getting on your statement or in your online banking. But all credit cards have something called a variable rate, so it'll change with the market. So the 5 C's of credit. So 5 things that go into deciding whether or not you're approved for credit is your character, your capacity, your capital, your collateral, and conditions. So character is you, who you are, right? They're going to look at, have you been making all your payments on time? So you've been sticking by the contracts of your other loans. Your capacity. So this could be like, could this person take on another loan payment? When they're looking at your credit report, they'll also look at capital, meaning like, does this person make enough money? Do they have enough money in an account maybe? Collateral, this doesn't apply to all the loans, but it might be like, does this person have a car that could back up this loan? Or is there property that they could use to back up this loan? And then conditions. So these might be some of the terms like market conditions. So sometimes it's a lot easier to get a loan if the market is good, right? Depends on the economy, that sort of thing. And the amount also. So what's the condition? So the bank, let's say that you might go in asking for a credit card for $10,000. And the bank goes, I don't know, this might not work for us, but how about we do $5,000? And then they approve you for a credit card for $5,000. So that's part of the conditions, right? How much they're lending you. And then the conditions might also be the purpose for the loan. Is it a credit card, a personal loan, a car loan? So all of these factors kind of determine if you get the loan, and not only if you get it, but also what your interest rate is going to be, how much you're going to get charged every month. So because of that, it's important to remember that you should only take on debt if It doesn't hinder your financial goals. So a lot of times people that are working to better their credit score, they will just continue making their payments until they pay off some of their loans. Or if you, in the future, decide to buy a house and you go get a mortgage, they are not going to want you to be applying for a bunch of different credit cards and loans at the same time. Because if you apply for a lot of things at once, it kind of puts a red flag on your credit report to lenders and tells them like, hey, this person might be in financial trouble because they're asking for a lot of loans or a lot of credit cards, that sort of thing. So you have to make sure that you are being careful that the decisions you're making are not going to hinder your future goals. You have calculated the total repayment cost, right? So again, that's back to my PlayStation example. If I'm buying a $500 PlayStation, I need to know that if the interest rate is 15%, I'm going to be paying 15% on top of the $500, right? And then you have a clear payment plan to pay it off. I might choose that I want to pay off that PlayStation in 3 months. But maybe I got 0% interest for 12 months, and I feel pretty comfortable spreading it out to pay it off in a year. So that's important to keep in mind too. How long am I going to pay this for? So credit scenarios. Now we're moving on to page 4 and 5. So this should be the next sheet over. Should have a purple bar at the top that says borrowing. So here we have the 5 C's at the top, and we have some credit scenarios. We're going to go over this first one, okay? So I'm going to read this out to you. Kelly is a college freshman who wants to start establishing credit. Kelly decides opening a credit card account is a good way to start, understanding that it will only be used for small purchases that can be paid off every month. Kelly works at a coffee shop on campus and receives a net paycheck of $400 every 2 weeks. Kelly has banked with the same institution since the age of 6 and has $500 in a savings account. How does Kelly stack up against the 5 C's? The 5 C's are at the top here, so you can look at them. So, Kelly, how is Kelly's character? Does it need improvement? Does it seem average? Does it excel? Or there's just not enough information? Does she seem like a reliable person? So Kelly, she's had an account since she was 6. She has some money in her savings. She has a job. She goes to school. Does she seem like a reliable person? Okay, yeah. Does she seem like she excels or maybe is average? Okay, yeah. And it does tell us that she doesn't intend to put anything big on the credit card. So yeah, I would say she's probably like an Excel. How about capacity? Is she going to be able to pay off the credit card every month like she wants to? She works a job, right? And she has some money saved up. So would you say she seems average or she excels? Seems average. Yeah, I agree with that one. How about capital, net worth? Does she have some stuff in her name already? She's got $500, but that's about it. I would say, but she is just starting out on credit. So would you say she kind of seems average? Yeah. What about collateral? Well, she's going to be opening a credit card. So this does collateral apply to a credit card?
It depends on what she uses with her credit card.
Yeah. I would say we probably don't have enough information on that one, right? And then what about conditions? external market conditions. Does the statement about her tell us anything about the economy or anything? No, so not enough information there. So, do you think the financial institution is going to give Kelly a credit card?
Yes.
Yeah, so they probably will. It probably won't be a really big credit card because she's new to credit, but she probably will get approved. And then if someone doesn't have a credit history or score, what are their options for establishing credit? Does anybody know? That's a tough question, actually. So if somebody is new to credit, the easiest way to establish credit is with a credit card. But sometimes you could also, if you rent, sometimes you can ask to get your rent put on your credit report so that you can start building credit. Also, if you don't have a lot of maybe a stable income, but you have some money in your savings account, you could also start off with a secured credit card, which would use the money in your savings account as collateral, meaning it's tied to your credit card in case you're not able to pay it. So next statement we have here, we'll do one more. There's three, but we'll do two and then we'll move on. So the next one here, Taylor on page 5. So Taylor is a recent college grad that just landed their dream job, earning $45,000 a year. Taylor had to finance their education with student loans, totaling $35,000. Taylor was supplemented expenses with $8,000 of credit card debt spread between two cards that are now nearly maxed out. During Taylor's freshman year, they took out their first credit card and missed the first two payments due to misplacing the bill statements. Taylor wants to celebrate their new job by purchasing a new $25,000 car. The manufacturer is offering 0% interest loans to buyer with exceptional credit. Taylor plans to use $2,000 as a down payment, which will come out of their very first paycheck. How does Taylor stack up? So character-wise, is Taylor like a pretty reliable person?
No.
Why not?
Because she doesn't seem like she's worried about her debt. She doesn't seem like she's trying to pay it back immediately. And she's already trying to buy something with her first paycheck instead of saving it.
Okay, so she needs a little improvement there. What about capacity? Is her income going to allow her to pay off her debts?
After like a couple of years, probably.
Yeah. It might be tough with that new loan too. So how about capital? Does she have stuff, the net worth to do that? She have money set aside? Yeah, not really. I mean, she said she'd put $2,000 down, but not sure if that's going to be enough, right? Collateral. Is there collateral here? So she's buying a car. So remember, collateral is things that back up your loan that if you don't pay, the bank could take away. So she's buying a car, so the car is going to be the collateral, right? So I would say that's probably like an average or excels because she does have the collateral, which is going to be the car. And then what about conditions? Does this tell us anything about the economy or the market?
A bit, yeah.
Yeah, I mean, it's telling us that the manufacturer is offering 0% interest loans to buyers, but they have to have exceptional credit. So maybe conditions might maybe need improvement or not enough info, I would say. So if you were a lender, would you approve Taylor for the car loan?
No.
Why not?
Because she doesn't seem trustworthy.
She doesn't seem trustworthy. Yeah. She hasn't, and somebody brought up that she's not really trying to pay off her loans, right? So she has a lot of debt, and she hasn't really been trying to pay off her loans. So maybe I would want to wait to see once they start making payments before I lend them money. So do you think the lender is going to provide Taylor with a 0% interest rate? Yeah, I mean, we don't have information on her credit score, but given the fact that she has a lot of debt, her credit score, it might not be very good, right? Okay. So we just look at these two scenarios from college students that are in different situations, right? So let's talk about credit reports. How fun. So, who knows what a credit report is? So, a credit report is like almost like a report card you get for school, right? It has all your classes, and it might have a letter grade or a percentage grade. Credit reports are kind of like that. They have everything from everything that you've done credit related for the past 7 years. And it doesn't go away until 7 years go by, and then it falls off of your credit report. So that's why you have to be really careful with what you decide to do with credit, because it's going to stay on your record for 7 years. So credit reports have all the information about your loans. And then you have something called a credit score. So if a credit report is like a report card, your credit score is probably most similar to like your GPA. Do you all know what a GPA is? Yeah, grade point average, right? Usually is on a scale of 4, but that can depend depending on the school. But your credit score is kind of like your GPA. Overall, that number sometimes is used to sum up what type of student you are, although it's not the whole picture. And that's the whole thing, is that, remember earlier I said that the credit score system isn't always the best, but it's what we have? Kind of similar to that. GPA system, maybe it's not the best, but it's what we have, right? So, how do lenders determine your credit character? So, lenders, again, they figure out what your character is, one of the 5 C's, by utilizing credit reports and scores to determine who you are. So credit reports, again, like a report card, has all the information from the past 7 years, from all the lenders, all your payment history, what your current balance is, when your due date is, how many payments you've missed, and how many have been late. All of that information is on there. And who is reporting this stuff? So there's 3 companies, and they, Tabitha? Oh, there's 3 companies, and they create these reports to send to people that you're applying for loans with. So the companies are called Equifax, Experian, and TransUnion. They're also sometimes called credit bureaus, but they're just companies, and they do make a profit off of doing this too. Okay. So how does a person get their credit report? So usually, most people don't check their credit report every day. It's pretty uncommon. But the federal government does say that you can look up your credit report for free at least once a year from each of the credit reporting companies through a website called annualcreditreport.com. Once you turn 18, you'll be able to go on there and look at your credit report. And it's usually recommended that you look at it 3 times a year, just so that you can keep tabs, make sure there's nothing weird on there, no accounts you didn't open, no addresses that aren't yours, that sort of thing. So, again, you're entitled to 1 credit report from each of the credit reporting companies. If you're denied credit, you can also request a credit report. If you're a victim of fraud, you can also request a credit report for free. And if you're unemployed, you can request a credit report for free. Now, the credit reports tend to be free. A lot of times, if you want to know what your credit score is, they might charge you for that, just because it's a separate product they sell. So, reviewing credit reports. So, now turning on to page 6. It should look like this green chart, page 6. So credit reports, page 6 and 7, we're going to be looking at. Credit reports, they're kind of hard to read, I'm not going to lie. But this is literally what it looks like when you go in to look at your credit report. When lenders like banks and credit unions get your credit report, this is what it looks like. So this one is for somebody called Lily T. Lane. So at the top, we have personal information. So this is Lily. Identification number. That usually just belongs to your credit report. Addresses. So this person lives on 168 Money Street Foundation, and they have an address number and the residency type. If you have more than one address in the last 7 years, that will also show up on there. And sometimes there will be a date from when you live there. Sometimes there won't be any dates, just depends. Social security numbers. You might have more than one if you maybe had like an ITIN and then maybe you got a social security number later. Your year of birth. Maybe if you're applying with somebody else, they might show up on here as well. There's also some notices, like credit may have been established before 18, meaning maybe you had a credit card before you turned 18 with the help of a parent. There's public records. So this person looks like they live in Lincoln County, and they have a judgment recent balance of $4,500. They make a $325 monthly payment in child support. So that's what this is, right? Now, they have some accounts here. This first one is a credit card. They named it 168 credit card. Their monthly payment is $10. Their balance is $273. They opened it in 2018. The last payment they made was for $50, and the credit limit is $15,000. And then at the bottom, you can see their account history, so how many late payments they've made. Now, if you notice, all the green check marks are on-time payments, and the red numbers tell you how many days late it is. So it could be 30, 90, 60, 90, and 120 days. So on the second page here, page 7, we have some other accounts they have open. So they have a mortgage, or sorry, this is an auto loan for a company called Hometown Auto. They're going to be paying it down for 60 months, so 5 years. The car, when they bought it, was for $19,118. And their monthly payment is of $350. And they've been very responsible with this payment because they haven't missed any payment, as you can tell from the bottom. And then we also have an apartment inquiry. So American Apartment, they signed a lease for 12 months. And it looks like the original lease they signed for was for a total of $12,000 for 12 months. So that would be $1,000 a month that they're paying in their rent. So their monthly payment's $1,000. They moved in at the beginning of 2020. And at the time this credit report was pulled, they only had 4 months left in their lease, right? And they've made all their payments on time. And then at the very bottom of page 7, there's a section titled Inquiries. So we have an inquiry from American Apartment, and it was December 2019. And remember, they moved in January, so they applied a month before they moved in. And then there's some contact information for the credit reporting company. But so as you can tell, American Apartment, they inquired about their credit report to find out whether or not they should rent to them. And they had to do that before they moved in, right? Is there anything you notice on here that you have any questions about? On page 6 and 7? Okay. So, credit report to-do list. What do you do when you have a credit report? Well, first, you have to check it regularly and carefully. So, You need to make sure that your name is on there spelled correctly, your social security is correct, your current address is correct, and that there are no accounts or inquiries you didn't approve on there. If there's anything wrong with it, you want to contact the credit reporting company or agency that you got it from. You want to, again, look for accounts that aren't yours, verify credit limits and balances. That's also important. If there's anything on there that you didn't do, you want to let them know ASAP. And then make sure the accounts you have closed are marked as closed at consumer's request. Sometimes if they're just closed and it doesn't say that you requested to close it, it can affect your credit score negatively because lenders might think that the bank or credit union closed it because you were not keeping up with it or something. So, correcting errors. Check your credit report regularly to catch errors early. You can always send a dispute to the credit reporting agency and then inform whatever company. So let's say you have a loan at ABC Bank. You want to call ABC Bank and let them know, hey, I saw in my credit report that there's a mistake on this so that they can fix it as well. Now, credit scores. What's in a credit score? So how many of you have seen ads or commercials for credit score stuff? Credit Karma? Experian Boost? Nothing? So credit scores, they range from 300 to 850. Now, there are some certain numbers that are seen as better than others. And it also depends on your lender, what score you need to have to get a loan or a credit card from them. But 800 plus is exceptional. And let me tell you, I've only ever seen an 850 credit score once. It's really hard to get anything above 800. Most people that have really, really good scores are usually above 700. But, so 800 plus is exceptional. 740 to 799 is considered very good. 670 to 739 is just considered good. So that's a good place to aim to kind of be, especially when you're first starting out. You want to be in that range. Fair is 580 to 669. When you turn 18 and you start trying to get credit, your credit score actually starts at 0. But it can quickly, after you make like your first 1 or 2 payments, it'll quickly jump all the way into the 600s. It's a lot easier to build credit from 0 than it is to rebuild credit. So like if you've already had credit and it just keeps going down, it's harder to rebuild from like a 300 than it is to start from 0. So 580 to 669, again, that's fair. It's usually where most people start out when they first start making payments. And then poor is anything below 580. So 580, it's usually really hard to get loans because, again, usually a big part of that is probably that you've missed some payments or there's too much debt. And then these credit scores are all created by something called FICO, which is like an algorithm. They have calculations to figure out what your credit score is. But you or your parent or guardian at home can check their credit scores going to myfico.com. So credit scores, right? Talked about it. It's kind of like a GPA. It's just a number assigned to you based on how you've done with credit. So if you manage your credit well, you'll probably get a good score. So let's take a look at how to do that. So when you obtain your credit score, usually you can get that from a credit card company. You can also use something called mint.com to look at your credit score. Credit Karma, which I've seen many ads, online at least, but Credit Karma is an app that you can use that'll track your credit score. And there's also something called FICO Estimator. All of these, though, it's important to understand that all of these are kind of estimates of what your credit report is at the time. In order to get like an accurate credit score, you need to pull your credit report. And usually it doesn't get done unless you're applying for a loan. So what makes up your credit score? Most of it, 35% of your credit score, is made up by your payment history. are you making at least the minimum payment on time every month? That's 35% of your credit score. The next big portion is balance to limit ratio. So that's 30% of your credit score. So balance to limit ratio means how much do you owe versus how much do you have available. When you max out your credit cards, you don't really have much available, right? So when we look at that, you want to make sure that you're keeping your credit card balance at around 30% of your credit limit. That means if you have a $15,000 credit card, you don't want more than $5,000 carrying over to the next month. Because if the closer you get to your credit limit, the more it looks like you might be in financial trouble, right? So then it's harder to get approved for other loans. Then there's 15% of your credit score is made up of the length of history. So how long have you had credit? A lot of times when they turn 18, people will get a credit card. It's important that you don't close that credit card because that credit card is going to help you establish that length of history. By the time you're 25, you'll have your full 7 years on your credit report showing of your credit card history. And anytime you open a new loan or credit card, it's going to be affecting your length of history. It makes it shorter because it's average. The next 10% is the mix of credit. So if you only have a credit card on your credit report, it's going to be harder to get approved for other types of loans. But let's say you have a credit card and you maybe have like one small personal loan. That helps it. You need to have a good mix of credit products. Let's say that you want to buy a car and you have enough money to buy it outright. But if you finance half of it and you pay that off, maybe even a little earlier, it's going to help you build a better mix of credit on your credit report. And then there's new credit. That's another 10%. So this is also like if you have a credit card and you haven't used it in like 10 years, your credit score maybe never improved or maybe it's gone down. And it's not because you haven't been paying off your credit card. It's because you haven't been using it and you also haven't been using other types of credit that you have available. So it's also nice to see that you're actively using your credit and maybe you're opening a new account. Not regularly, but maybe like once every 2 to 5 years. So we talked about this, so I'm not going to go over this, but this is the debit card versus credit card, and what are the differences? So if you have a credit card, our friend you shared that, they have one, or debit, right? You said debit? Yeah, never mind, debit. But usually if you have a credit card before you're 18, it's usually because a parent adds you as an authorized user. So then you get your own card with your name on it, but it's a credit card. So again, it's money that your parent is borrowing from the bank. So ways to establish credit. So primarily, you could open up your own account. You could become an authorized user on somebody else's credit card. You could also start a secured credit card, which we said is like a savings account is used as collateral in case you can't pay your credit card. You can see if your bank or credit union offers a student credit card. Sometimes those have like cash back or they offer lower interest rates for students. Or if you want to get a credit card on your own and you don't have a stable income when you do turn 18, you can see about getting a cosigner. And this could be a parent, a guardian, or maybe a spouse. Secondary, you can also, again, request that your rent, utilities, and your phone service be reported on your credit report. That way you can start building credit without taking on debt. And if you don't want to open up new credit accounts, you can add those even if you already have a credit card.
I have a question.
Yeah.
So if you're paying rent, utility, or phone, and you want that to show up on your credit report, do you have to do something special to get that to happen?
Yeah. So first you need to ask your landlord, utility company, if they offer that. Sometimes they will offer it, and not a lot of people take it. So you just want to ask if they have something in place already. And if they don't, you can always look online. And there's third parties that will allow you to enter information from your landlord and from your like the account you make your payments out of. And that way it'll track it and report it on your credit report. So there's third parties, or you can do it directly with your landlord if they offer it. So, credit card cycle. First, remember we talked about finding the right products? First, you have to find the right credit card for you. And there's so many options. You can get a store credit card. You can get it at a bank. You can get it at a credit union. You can get it at an airport if you apply for an airline card. All of these have different benefits, and it just depends on what's important to you. If you like traveling, you might want an airline credit card so that you earn miles so you can redeem it for more trips. Secondly, once you find the right product, right card, you want to use it. If you don't use it, it doesn't help you improve your credit. You want to pay it every month on time, at least the minimum payment. But if you can pay it down to at least 30% every month, that would be the best. And then you want to maintain it. You want to make sure you're checking the statements to make sure there's no fraud, there's no extra fees, that you're staying on top of your transactions as well and your spending. When we talk about credit, it's important to keep in mind something called SMART goals. How many of you have heard about SMART goals? Yeah. Yep. We use that a lot with financial beginnings. So, SMART stands for specific, measurable, attainable, relevant, and time-based. So, on page 11, so it should look like this. It should say SMART Goals worksheet on one side, page 11. I want you to come up with a goal. Remember, it has to be specific, measurable, attainable, relevant, time-based. So I'm going to say that as long as it's related to money, I want you to come up with a goal that fits the SMART goal criteria, and it has to be related to money. I'm going to give you about a minute or so to come up with a goal.
It has to be about money.
Yeah, about money, yep. Anything that relates to money. Could be that you want to buy something, that you want to save a certain amount. Could be some goals for like, what do you want to do when you turn 18, or getting a credit card, or a goal about talking to your parents about getting an account. Okay. Okay, does anyone want to share their goal? Yeah, what's your goal?
To save money and buy something bigger.
Okay, cool, yeah. There's a goal. For me, one of my goals is to be able to make payments that are a little bigger on my credit card so I can pay them down sooner. That's one of my goals. So we're about to end this lesson here. Some takeaways for you. So when taking on debt, make sure that you are leveraging it to achieve greater goals in your life and that it's not going to be a hindrance to you, right? Do not overuse credit and make sure to make payments as agreed upon. You don't have to pay it all off every month if you can't, but at least the minimum payment every month on time is so important. And then establishing strong credit early on and periodically checking your credit report, again, is going to be really important because you're going to need credit a lot in life, especially as you try to do things on your own, like renting, buying a car, buying a home. Credit is very important. So, again, you can establish it as early as 18, but you have to make sure that you're responsible about the credit that you are getting. Okay? So, does anyone have any questions about any of the topics we talked about today? Okay, well, I just want to say thank you all. It's been a pleasure to be here with you today. And if you have any questions or anything comes up, feel free to let me know. I know we finished a little earlier. Tabitha, do you have anything else?
We did finish a little early.
Yeah.
But lunch isn't going to be ready.
Okay.
So we're all just going to chill here.
Cool. Okay. So what do you guys normally do when you don't have a guest speaker in here? You sit on your phones?
Pretty accurate.
Did you guys get to do any, do you guys